Okay, so welcome to this first FlexUp startup networking event. Hopefully the first of many. We're recording this, and this is going to be posted online so that other startups that are facing the same questions can learn by seeing how FlexUp works in practice for other startups. Also, it's not only about FlexUp, it's also about startups and entrepreneurs sharing ideas and sharing some of their challenges and situations they're facing where, we can all exchange some ideas and recommendation. It's kind of an informal format. Some of these events are going to be online. Some hopefully more and more will be in presence. We're having an event in Paris 2 weeks from now. So as an intro, I'm going to say a few words about FlexUp. And for those people that already know all about FlexUp and are viewing this video online, you can skip to another time that will be indicated in the comments below the video. So let me share my screen and I will say a few words about FlexUp. So hopefully you can all see my screen. So FlexUp, what is FlexUp? It's basically a platform designed to help uh, businesses, help entrepreneurs start their business, and help managers and business owners grow and manage their activity. It includes basically three pillars. On the one hand, we've got a new economic model, which is basically a recipe for a new way of doing business, a different way of creating collaboration agreements, creating businesses. It's a new way of sharing risk and return in a transparent and simple system. And there's, of course, the whole contractual frameworks that allows you to put these ideas in practice in a solid legal environment. Then we have a business app, which allows you to keep track of all the transactions and the commitments that have been made. The idea is basically you should be able to start and manage your business from your mobile phone, even before you actually incorporate a company, because for some startups and for some entrepreneurs, in the early phases, you want to focus on your business. You want to make sure that you can, validate your ideas, maybe do some prototypes, and you don't want to be committing a lot of costs or a lot of administrative work before you're, pretty clear about your business idea. Also, when you're collaborating with some partners, you don't always know initially who's going to be doing what exactly. So the possibility to create a clear framework for doing business together and having a simple app to manage this before you invest heavily in the administration of your project, that can be very beneficial. And then the third aspect is a network of partners to help you and accompany you during your entrepreneurial journey, whether it's people that work on a full-time basis for FlexUp that can help you in your business, or maybe partners that have their own activities like lawyers or accountants or business coaches that have their own activities and are part of the FlexUp network and are ready to help. So you can go on our website, flexup.org. You will see there's a lot of information here. You can apply to start using FlexUp for real as part of the Trailblazer program. You get 1 year free access and 3 months free for all paid plan for using the app. You can see all the information about our pricing plan here. You can see that there's a very generous free plan, and it starts at 20 euros a month and 50 euros a month for using the app. We also have different types of advisory services that we can provide: technical support, operational support, even strategic advisory. And the rates, of course, vary depending on the type of support we're providing. If you don't have the cash to pay for these services initially, we're always willing to provide the services on an equity basis. And that's the heart of the FlexUp system, is basically to allow to hire your team and hire your partners using a flexible remuneration system where you basically can pay people with some equity. There's a page here about the FlexUp economic model that tells you all about, how it works in practice. So you've got a mix of firm payment that you pay every month, flex payment that you pay if you have cash, otherwise it converts into equity. And then credits, it's basically the share of your remuneration that is paid directly in credits. And the idea is, whether you're an employee, an investor, a founder, or even a supplier client, it doesn't matter. We're all in the same boat. We work together, we share the risk, we share the pain, and then we share the profits. So again, I don't want to spend too much time on this, but there's a lot of information on the FlexUp website about what FlexUp is all about. There's also some information about our FlexUp app, where you can understand what the features are. But the best way is to actually start using the app. You can just sign up. For example, here are a lot of examples. You can just go on our sandbox environment called sandbox.flexup.app. Watch out, it's a .app as opposed to the .org, which is our information website. So .org is our main website. .app is the web-based application. You can just sign up, create an account, and then play around. It's a sandbox, right? Sandbox environment. You can also go into a demo environment and then see some real examples, or some simulated examples, rather, I should say, simulated examples. So you have different case studies that we publish, and we're going to add a lot of case studies all the time. Now we already have 4. So Café Alphonse is one example. You have a bit of information here about what this business is. So some entrepreneur opening a cafe in a small village in Burkina Faso. And in order you can read the whole story, you can download the business plan, the presentation. There's a lot of material that you can download and read, but you can also actually go into the app, log in, and see what it would look like in practice. So you just type cafe@example.com. The password is demo, and anybody can just log in. And then you will see the whole app. There's a little wizard that tells you, what the different aspects of the app are. And so let's say I go into the cafe account, and I can see here all the third parties that I do business with, how many orders I've made, how much sale or purchase I've done overall. And you can see the equity structure. So in this example, you have Alphonse, who's opening a cafe. He's got a friend who made a bit of an investment, and then there's a bank who also chipped in. And you can see how much each of the 3 associates have in terms of credits, tokens, and equity. So basically, that's what the FlexUp app does. It allows you to keep track of all your transactions, all the contracts, all the orders, and then all the commitments that you've taken, whether you're paying somebody firm or you're giving them some tokens, or you're using a flexible remuneration structure. There's a lot of things that this app can do, but it's actually also quite simple to use. You can just do it from your mobile phone. So I think that's as much as I want to say at this stage. There's a lot of resources. You can download some tools. You can download some presentations. And of course, we've got all of the standard contracts template that we publish. You can create your project. If you sign the FlexUp charter, you can hire team members using the standard professional services agreement that you can download here for free. You can do a funding round using the investment contract template. And this is actually the one that Lara used when she did the funding round for her business. So there's a lot of material. There's even a blog, there's a forum, whatever. A lot of information here. Podcast, everything. But I think at this stage, that's all I want to say about FlexUp. And I want to focus now on your specific businesses and try to see how we can share some ideas here. So I'm going to stop sharing my screen. And now, maybe Lara, if you want to start, that would be great. Maybe say a few words about you, your business, and anything you want to share or ask to the rest of the participants.
Okay, great. So I think first I want to say something to you, Fabrizio, because as you were explaining this, I was thinking that any idiot can make something more complex, but it takes a genius to take something complex and sort of make life simple for other people. So what you did with FlexUp is actually you simplified my life greatly, but it required you to do this complex thinking and come up with this brilliant solution. So I'm very
Thank you,
thankful
Lara.
for you. Thank you, Fabrizio. So yes, so my name is Laura. Nice to meet you, everybody. I am the CEO and the founder of True Local Heroes. And True Local Heroes is a service platform that is based, it's actually for the American market. It's a neighborhood platform. So to just describe it like very briefly, it's essentially it's a place where every neighborhood has an online sort of digital town square, and in this town square, people who are looking for help can go and search for like the people in their town offering help, and anyone who has either a service or a business can create a listing for free. So it's very simple, actually. The idea came to me in 2020, and I sort of slowly worked on it with my small team because I had a marketing agency. And then in 2023, we got really serious. And at that time, like I had some cash saved, I was bootstrapping. And when I got serious, I thought to myself, okay, you know what? It's now or never. I am going to close down my marketing agency. I'm going to devote all my time to this because this is a very, like, it's an idea that I believe in. Um, so, you know, life never goes quite how you plan. And so before I knew it, my cash was running very low and I was panicking. I was thinking, like, what can I do to make this happen faster? You know, I had my team, they were willing to like do some like work for me while they were still getting paid, you know, from my previous, like from when I was previously paying them when they were doing work at the online marketing agency. But when the online marketing agency shut down and then the money dried up, I was in a real quandary. Um, so at that point, you know, some of my team members said, yes, we will help you. But you know what? If we need to look for work elsewhere, that's going to require our focus. And then I thought, you know, as I was reading, I was thinking, there's no way that I can avoid this. I'm going to have to raise investment capital. And so at that point in time, I contacted everybody I knew. And Fabrizio was one of the people. I sent everybody my pitch deck, and then Fabrizio asked for a meeting and he said, you know, I've been working on something in the intervening years that I think could be useful to you. So as I started to explore this, I realized just how useful. So you know, FlexUp's got these various pillars. Like Fabrizio explained it, it's the economic model. So like I would say that's the very basis of everything. It's a system that really guarantees fairness to everybody. So the first people that I actually introduced it to was my team. And I just did a beautiful 1.5 page PDF where I said, explain to them in simple terms what FlexUp is and you know how it like supports my core beliefs of that of fairness actually. So as they read it, and like I can show it to you, but I'm not going to because you're not going to want to read it right now, but I'm happy to share it. But as they read it, like they got excited. Each and every one of my team members got excited because for the first time ever, someone is offering them, like in their fairly low level roles, offering them part of something bigger, like equity. I mean, usually you only earn equity if you're in a like in a like in a very high at working at a very high level in a company. That's when you're offered equity. So in this case, they being offered something for the work that they're doing, and they started to feel part of it. So if, immediately, like I just got this, the the energy level and the enthusiasm just tripled, and so from that time until now, I've had many people like help, like sometimes moving in and out, but always such enthusiasm and such gratitude, deep gratitude for being offered this opportunity to be part of this. So that's the team function, and then the investors. So when because it's a US-based company, I was investigating all the different vehicles and the typical ways of raising capital. And there's a lot of things that you have to do if you run an investment round. I don't know if it's like that all everywhere in the world, but in America, there's a lot of rules and things that you need to follow. And and so I navigated that as best as I could, but then with the help of Fabrizio, finally discovered that FlexUp is going to just make this a lot easier, a lot clearer, and also a lot fairer. Because if you're trying to raise money in the US, there's something called the SAFE, which was a vehicle that was created by um, the incubator that was responsible for Airbnb. But if you go and look at the SAFE, you'll see that it doesn't really align investors with entrepreneurs. It still pulls them apart a little bit, and it doesn't actually guarantee investors. It doesn't guarantee investors return, because basically what the SAFE says is when we do a priced round, which is when we raise Series A, B, or whatever, at that point you will receive your equity. But many companies who are raising money never actually do a priced round, or they can choose not to do a priced round, and then those investors don't actually get the equity that they deserve. So this is a way to do that. And then so the other thing is, other than safes, you also get convertible notes, which is like you're basically lending money that needs to be paid back. But a convertible note always has a date. So what sometimes happens to companies is they'll get investments as convertible notes, and then the time runs out, and then they have to repay, but they haven't started making the revenue yet. So it's just the current options are just bad for both entrepreneurs and also for investors. But FlexUp just makes it so easy to understand and so easy to actually administer, because that's the other part. When you're raising a round, there's a lot of administration, a lot of paperwork, lots of hoops to jump through, and FlexUp really makes that easy. So I was able to raise a round of funding in 2024, and then in 2025 I was able to raise another round of funding, and I'm very happy to say on January the 17th, now a few days ago, we finally launched. It's a soft launch, so it's not, if you go to www.truelocalheroes.com, you're going to see the coming soon page. But if you type /home, you'll see the real site, which will open in the next few weeks once we've ironed out all the bugs. We've also had our first paid subscribers, like converting at about a rate of 20%. So it feels great. I'm very grateful. I logged into FlexUp today, Fabrizio, because it was time to tell the team, it's the end of the month, go create your order so that I can pay you, so we can make sure that everybody is like, everything is tracked and everybody gets what they deserve. So yeah, that's in a nutshell. That's True Local Heroes and FlexUp, our journey. If you actually go on our About page, so remember, you have to go www.truelocalheroes.com/home and then navigate to the About page. If you scroll all the way down, there's a tribute to FlexUp there.
Thank you, Lara. I mean, you speak about FlexUp so much better than I do that really you should be our communication manager. I would never be able to say it in such nice words. And
Oh, thanks. Yeah.
yeah, so let me just highlight a few of the points that you mentioned that are potentially interesting. So one of the ideas is that basically this idea of non-discrimination. So the founder, the employees, and the investors, they all contribute in very different ways, different types of contribution and different amounts, of course. Some people take more risk than others, but at the end of the day, everybody's getting equity on exactly the same terms. And that's, I think, one of the ideas that creates really fairness. It also allowed you to give a value for the work that you did in all the years before you did the funding round. So when you actually did the funding round, instead of having like a crazy high valuation that you just pluck out of the sky, and you use this super high valuation to explain to your team or the investor that you're giving them only 0.1% of your business and that's worth $100,000, you actually basically you do the valuation based on the real investment and the real work that was invested in the company. So the other people feel that it's fair, right? And I think that's one of the criteria that not only makes it easy because you don't have to do a crazy business plan with wild assumptions to justify the super high valuation. You just have to keep track of all the money and time and work that you've invested in the business, and the app calculates it automatically. That's one feature. The other feature that I want to maybe mention is regarding company valuation and early dilution for the investors. I think that's one of the issue you were facing because initially you give away a lot of your equity on a very low valuation because that's exactly what you do. You basically look at how much money was invested. So your valuation initially is very low. That means that when you're giving away equity, you're diluting very fast. So that's one area where FlexUp introduces a mechanism which we call the redeemable equity, where the company has the option to buy back some of the equity that it issued at a very high price. Let's say it, right? So the price is high. That means that the employee or the investor that put some money on the table, they know that they would get a very high return if this buyback option is exercised. But for the founder, it removes the anxiety of saying, oh my God, I'm giving away too much equity too soon. I'm going to lose control of my company. I'm going to look like a fool when I go and see the VCs. And then in the next round, I'm going to be diluted even more. And at the end of the day, I'll end up with only 10% of the company that I founded. So that's one of the core business problem that we try to solve, because in the current system, you have like some entrepreneurs, they spend 6 months thinking about an idea. They do a very nice PowerPoint presentation. They go to see investors and they say, my company is worth $5 million. And if investors buy in, it's great for the founders. I mean, if you can pull that off, that's great. But if you wanna then give equity to your team and you say that the company is worth 5 million euros already or $5 million and you're giving them 0.1%, that doesn't sound fair, and it may reduce the motivation and the drive, right? So the fact that you give them equity on a simple, transparent, and fair basis, while at the same time having the option to buy back some of that equity. If you manage, I don't know, to give them 10 times their money, I think they're still well off. And if you give them, I don't know, 3,000 euros a month of equity, and then you buy it out at 10 times the money, that means that they were making 30,000, dollar or euro a month for all these years. They can be, pretty happy. And it allows you to give away equity without being afraid of dilution. I think that's one of the mechanisms that can address some of those concerns and difficulties that businesses are facing.
Yeah, I just wanted to say one more thing quickly. Um, just about this. At some point, I did have that anxiety, and I said, I'm being diluted, and then we spoke about, well, what are the options? So the options are go, get capital from venture capitalists, but that's also going to dilute me. So who do I want to dilute myself against? The people that I know who are working side by side, or like some unknown people right now. So when you're as an entrepreneur, when you're in that sort of, that crunch and you have to make this decision, and if you can find a solution um, where, you are diluting yourself, but with people that you trust, um, because like creating a startup is just like it's one thing after the other after the other. It's like you don't necessarily have the luxury of going to find people to go and find like investors that you trust, right? So being able to have a system that you trust, FlexUp that you trust, FlexUp that your team trusts, and then if an investor is weary of this system that is so fair, that also tells you something about who they are, because many entrepreneurs like later get screwed by investors. So that's just another facet of this that was very
Mhm.
meaningful to me.
Yeah, that's interesting. Now, of course, if you're pitching your business to investors, you would never approach them with a cost-based valuation. Then you would try to have a future profits-based valuation. And then it's a game between the founders and the investors. The founders, they always try to inflate the value of the company so that they can raise cash with minimum dilution. The investors, they know that the business plan you come up with are based on assumptions, and sometimes those assumptions are overly optimistic, and they're going to try to negotiate the valuation down. So there's already a conflict of interest from the start, because your objective is to maximize the valuation, their objective is to minimize it, and you both of you are just speculating because you don't know what the future value of the company is. So that creates friction and tension. Now it does work. I mean, the whole world works like this, right? So I'm not saying it doesn't work, but in certain situations, having a cost-based valuation where you share with a limited circle of employees and limited circle of investors really makes sense. Okay. Is there anything else that you want to share about, your journey or your business? Or maybe I can open the floor to Marina, who also wanted to share a few words.
Sure, unless anybody else has questions for Lara.
Okay.
Okay. Would you like me to talk about our journey, Fabrizio?
Yeah, I mean, I think what I wanted you to join this call because the situation you're in is very, very typical of many early founders that are still in the early phases of thinking about how to structure their business. And a lot of the questions that you asked me are quite typical, and a lot of it would allow me to illustrate how FlexUp allows you to answer these challenges in a very simple and transparent way. So feel free to tell, general context of your business, your team, and then we can go from there.
Okay, great. Thank you. As Fabrizio said, we are at the beginning of our journey because we are a group of 5 students from an executive master that realized a final graduation project and then decided that we actually wanted to convert this into a startup. We already see the commercial potential of this kind of service, which is let's say an HR tech type of business, which will allow companies to understand and better analyze how their workforce can be retrained and reskilled via both augmentation and automation based on the current state of AI, current and future development of AI. So we've been working on this for a few months for the purpose of the master. And now we are in the phase of deciding everything from scratch on how we would like actually this company to start. And we're realizing it's quite a journey because all of us, we are people that are full-time employed. Some of us are at the moment looking for a job, others are freelancers, and most of us are fully employed. So this creates obviously, doesn't give us a lot of time to look into the specifics of the administrative part, the legal part, and most importantly also the equity structure and setup, because we know that our situation can change. It depends on the health of the company once it's created, but it also depends on our future career paths. And we are 5 people, which adds a little bit to the organizational burden. So all in all, to say that we came across Fabrizio, which is a friend of mine, who has been tremendously helpful in indicating to us how FlexUp works. And we are now studying a little bit how this could be applied. And we already like very much the idea of fairness behind it, and the fact that it really lifts a lot of the administrative burden potentially for us. Maybe Fabrizio, you want me to ask some of the questions that I had in mind, or do you have other questions for me maybe?
Yes, I mean, before I take your questions, I just want to give a parallel because I've had a few months ago a discussion with another group of founders. There were 3 people. They were in different countries. One of them was working for the UN, another was working for a private corporation, and a third was a freelance, a consultant, basically. They wanted to start a business together, but they didn't know in which country to do it, how to structure the deal, how they would share the equity. They had very different seniority levels, and they, of course, had very different pay levels. They did not know initially if they would need to put cash in the business or if they would just be working with, earning sweat equity. They did not know yet, if this business was going to work. So, if one or both of the guys that were currently employed, if they would have to quit their job and go full time. And of course, if they do quit their job and go full time, or if they just stay on the sideline and work a few hours a week, that's a completely different story in terms of the intensity of their contribution to the deal, to the project, and therefore how much equity they should earn. So they were basically stuck in limbo, frozen by all of these questions, and therefore they were even starting to work and focus on the business because they were completely paralyzed by all these questions. So basically what I said, look, why don't you agree, each of the 3 of you, on the value that, let's say, the value you have provided so far, because they had done some work, like they had done some research and they already had some. So I said, let's freeze a value that each of you has provided so far. Maybe, like, let's say, make it simple, $50,000 each for the work that you guys have done over the last 6 months. And then you should just agree on some kind of remuneration that each of you 3 think is fair and that you can justify to the other 2. So, maybe an hourly rate, or maybe one guy is going to focus on bringing business and he wants a percentage fee on any clients he provides. So you can think of any kind of, remuneration system depending on your profile, the type of contribution, as long as you agree on, what each person is going to do, what is a fair value for whatever service contribution you provide. And as long as you agree on, let's say, a starting point, then you just use the FlexUp system and the FlexUp app to do very basic bookkeeping every month. Who did how many hours, who brought how much business. You calculate how much that is worth, and then maybe initially it's just like everything is paid 100% on equity. So people start accruing equity, and then maybe 3 months, 6 months down the road, when you get some traction in the business, then maybe one guy can quit his job and go full time, and then he can say, well, we agreed that I would be paid 50 euros an hour, and I was only doing 10 hours a week, but now I'm full time, so now I'm getting like 40 hours a week. I'm still 100% equity, but now I'm earning more equity every month, and then my share of the total pie is increasing because now I can contribute a lot more every month. So that was kind of the setup that I was suggesting to them, and maybe some of that resonates to you. But now that I gave a framework of reference, now maybe I'm open to your questions if you have specific questions, Maria.
Yes, thank you, Fabrizio. Indeed, that's super interesting what you say, because it's also exactly what we're going through. We are all based in different countries, although we do know where we want to start. We want to start in Italy, where the majority of us are based. I think some of the things I struggle at the moment, and maybe I am anticipating a little bit of issues, it's actually the difference between the founders slash those that actually make the decisions slash those that operate, because among the founders, there will be people that will not be able to have executive responsibilities all the time, and others that want to be executively involved in the company. So do you think that this is something that I shouldn't worry about too much right now in terms of who are the holders of the decision, and it's okay if everybody's involved, even if some of them don't have executive responsibilities and just are just founders that have put a bit of capital and contributed so far, but we don't know how much they will contribute into the future? What is the best practice that you would advise us to have?
Okay, yeah. So there's a lot of questions here. So I'm going to try to unwrap all of that. And sorry if I don't do it necessarily in a very structured order. But so the FlexUp economic model is based on the FlexUp Charter, which is a very long document. It's about 70 pages that tries to explain how the FlexUp system works, like from A to Z. And it talks about governance, and it talks about how you get equity and what equity gives you in terms of voting right and in terms of financial rights. Now, FlexUp is mostly focused about, when you talk about governance, and the FlexUp Charter is focused on decisions relating to cash allocation, budgets, cash allocation, and any changes you want to do on, the token valuation and the way you allocate cash at the end of the year between buying back the equity and keeping cash aside to fund the growth. So we have in the FlexUp Charter a governance model that's described. And to summarize, you have the holder, which is the individual person or the legal entity or the group of individuals that collectively own the project. And as they own it, they manage it from an operational point of view. That's what I call the holder. And the holder can be many different things. And I will explain what the different scenarios are. Then you have the associates, who are the people that have earned equity by taking some risk in the company. And basically, the equity comes in two forms. What we call credit is basically like a loan. How much money or how much of your work have you actually invested in the business? It's like a loan. You measure that in a currency, whether it's dollar or euros. And then you have the tokens, which is a bit like a share. It's like one token gives me, one voting right and gives me one share of the future profits. And the token price can go up and down, but as long as you don't have a priced valuation for priced funding round, the token increases by a fixed amount every year. By default, it's 25% per year. But if you're on a very low risk business, you can have a lower token annual indexation rate. So the token indexation rate is there to measure, the risk that you're taking and what is a fair return on your investment, considering the risk you're taking. So the token is a bit like a share, and that's where the voting rights are. So as long as you take risk on the project, you are an associate, you get some equity, so you get a mix of credits and tokens, and the tokens are what gives you a voting right. Now, all the associates, when they vote collectively, they are the assembly, what we call the assembly. So it's a bit like a general assembly in a proper company. But of course, what I'm describing here is the way the governance works independently of the legal structure. So whether you're a SARL company incorporated in France or Inc. incorporated company in the US or a GmbH in Germany, or if you're just an informal student project somewhere in a high school in Africa, it doesn't matter. The same principles work, the same mechanisms work anywhere. That's why, you know, FlexUp aims to be a global framework. And then for each country and for each specific situation, we add a layer of contracts and legal framework to make it compliant to the specific laws of that specific country for that specific context. So that's what we did when we had Lara do her funding round. We have the general conditions for investment agreement, and then we specifically wrote additional conditions for US funding rounds using SEC exemption 504. So we will continuously add specific conditions for specific environments. So when I'm going to talk about the governance of FlexUp, I'm first going to talk about it independently from the structure behind, and then we will talk about the different structures. But basically, you have the assembly that can elect council members, for example, 5 council members. So every token holder can nominate someone and then vote. So I can say, okay, I'm going to nominate Lara, and I'm going to use all my tokens to vote for Lara. And then Paula is going to vote for herself, nominate and vote for herself, because she wants to be on the council. And then Anouar is going to designate Thibaut as a council member. And then Nico and Bishwarab will all vote for Thibaut. So now we have 3 council members, right? So you can nominate and vote for yourself, for one of the other co-founders, or you can nominate and vote for an external director. You have entirely free. So the role of the council is to keep a closer look on the day-to-day management. When I say day-to-day, I mean, it would be, for example, like every quarter you have one council meeting, but you can have it more often, more frequently if needed. Just to basically the manager, the one operating the business, has the duty to report to the council. And when there are decisions related to cash, it needs either the approval of the council. If you want to make some expenses that are not provided in the business plan that has been approved, you need to ask the approval of the council. And if you want to change the value of the tokens or change how the cash is used and distributed at the end of the year, you need the authorization of the assembly of all the token holders. So that's the governance regarding financial issues according to the rules of the FlexUp Charter. Now, governance regarding the operational management of the business, that is something that the FlexUp Charter doesn't say anything about. Why? Because that depends on the type of business and the type of structure. So let's say that in the case of Lara, and if you allow me, Lara, I will give the specific example. Lara has created a company in the United States. She's the only shareholder. She's the only director, the operation director, the only executive director. And then she calls the shot. She's the manager, she's the CEO, there's no discussion. She alone makes the decision, the operational decision in the company. Because by law in the US, if you are the owner and the manager of a company, then you take all the decisions. But if tomorrow she wants to change the token index or say, you know, I don't want to use the money to pay back my credits because I want to focus on expanding the company, she needs to come to me and all the other associates to ask for our approval. But apart from that, and as long as she follows the business plan, she can do whatever she wants. She is, the only manager. So that's also one of the feature of FlexUp is that you can raise funds and you can even dilute yourself in terms of FlexUp equity below 50%, but you're still the manager. You're still the only one who actually controls the business, right? So it's another way of removing the anxiety of being diluted because you don't actually lose control of your business. You don't lose ownership, you don't lose control. But if people are contributing much more than you have contributed, then it's fair that they get also a larger share. And in some startups, there is this obsession for the founder to say, I need to keep more than 50% because I want more than 50, I want the control. Not necessarily, they don't necessarily want the lion's share of the profit. They just want to keep control. So the FlexUp system allows you to keep control while attracting investors and sharing the risk and the value with a greater pool of individuals.
Thank you, I understand. And is it because Lara is the holder that she gets basically this control over the executive part? What is it that
So
makes her
actually,
the holder?
in the case of Lara, the project is incorporated as a company. So it's not Lara who's the holder, it's the project, the company is the holder. It's a way of saying the project and the company is the same thing. And because so the governance, from an operational point of view, the governance of the project follows the rules of the company that Lara has incorporated. And then when you look at the rules of the company that she's incorporated, it says that by law, the manager has operational control, right? So it's like a two-step. So the FlexUp project, the FlexUp account has a holder, which is the legal entity, and then the legal entity has a manager. So the management of the company is in the hands of Lara because she's the manager of the holder who actually owns the FlexUp project. Now, why do we have a difference between a FlexUp project, which is an account on the FlexUp app, and a company? Well, simply because we want to provide the flexibility for a company to have several projects. And each project may have its own team, its own founders, its own investors, its own employees or whatever. And they share the risk and the profit of their project as an account without necessarily having to go through the steps of incorporating a company. And in that case, the holder can be a service company, which is just there to provide, like an incubator, it's there to provide a legal framework for startups to get started. And then once an individual project has enough maturity, then they can, fly out of the nest with their own wings. They can incorporate as a dedicated entity. And in that case, instead of the holder being the incubator, then the holder of the project is the company that was specifically created for that business.
Thank you. Great.
Okay.
Thank you, Fabrizio.
Were there any other questions or things you wanted to mention or ask about this specific project?
I actually had questions about tokens, but I don't want to monopolize. I know that discussing with my colleagues, Alessandro is also here, we wanted to understand a little bit better how the tokens are translated, like more like converted. If there's a specific mechanism behind that is fixed based on the values of fairness of FlexUp, or whether this is dependent on how each and every entrepreneur sets the rules of the game. You spoke before about the conversion rate, but I was thinking more in terms of the basic accounting behind it. Is it a fixed one, or is it something where also we have discretion on?
So generally speaking, FlexUp provides mechanisms and gives you a lot of flexibility in fine-tuning the parameters. So you don't have to reinvent the wheel. You just have to negotiate the parameters. Like, is it going to be 10? Is it going to be 15? So you just talk about numbers and not concepts, because the concepts are already well defined, right? So maybe there's two different questions in your question. One is, what is a token, and does it convert into actual shares? That's one possible question. And the other question is, how do we award the tokens initially? On what basis, and what is the fair value that you need to provide to get the tokens, right? So on the first question, and again, let me give you the example of Lara. Lara has incorporated a company. She's the only shareholder. There's no other shareholder. And now she's issuing tokens. The tokens are not real shares, but the charter that she signed, she selected the option explicitly that when there will be a share issue, then every token holder will have the option to convert his token into a real share, right? So it's a way of saying one token equals one share. In terms of value, it's one-on-one. But to simplify the whole process and to avoid legal cost and complexity, right now we're not going to issue real shares. We're just going to issue tokens. But there is a guarantee, it's a contractual commitment, that when she does a funding round and issues real shares, she must provide each FlexUp associate, the option to get one share for each token. And the tokens will survive. So the FlexUp system will still be used, or at least she has the option to keep using the FlexUp to calculate, to issue new tokens and to distribute the profits based on all the tokens. And then, but then some tokens will be connected to a share. Some will not yet be connected to a share because they were issued later. And that will be fully, I would say, not only it would be fully transparent, but it basically, there's no difference between a token with a share and token without a share. But at least it gives you a legal contractual basis to know that those tokens can at some stage convert to shares. But as Lara mentioned before, the big difference between the FlexUp system and the SAFE agreements is that you don't have to wait for a funding round with share emissions to actually get something, because you get your tokens from day one, and then you get the voting rights and the share of the profits from day one, right? That's one of the big difference. Now, trying to understand and answer the other question, so how tokens are issued and valued. So the ID and the default value is that, you start with a token price. Bye, Lara. Thank you so much for your participation. Have a good evening.
Goodbye.
So you start with the token index of 10 euros per token, or $10 per token, or whatever, and a default annual indexation of 25% per year. So that means that every day the token value increases a little bit. So if I put $1,000 on day one, I get $1,000 of credits. And because of the way FlexUp calculates risk, we consider that you're taking $800 worth of risk. And if the token index is $10 per token, you're getting 80 tokens. Now, if a guy comes a year later and puts the same $1,000, he will get the same $1,000 of credits. And also he's going to get $800 worth of tokens. But by that time, the token index has gone from 10 to 12.5. So instead of getting 800 tokens, instead of getting 80 tokens, he's getting a bit less. I can't do the calculation in my head, but it's like 60 tokens, whatever.
Right.
So that's the way tokens are issued, based on the value of your contribution and the level of risk you take. The value of your contribution, that's a completely different negotiation. And that's one of the idea in FlexUp, is that, what you do, how much you get paid, and how you get paid are three separate things. And first, you negotiate with your associates. What is Alessandro going to do? What is Maria going to do? How much should Maria be paid? Is she paid by hour, by month, by whatever? So you negotiate amongst yourselves your respective contribution and your remuneration. And after that, you have a separate independent discussion as to how much risk you're going to take on that remuneration. And if you're paid fully in credits, then you're getting an 80% risk factor on that contribution, and therefore you're going to get so many tokens.
Okay,
Okay, so Celine had to go. Does that answer your question, Alessandro? Maybe you had also some questions regarding the tokens.
Fabrizio, thank you very much for your reply. It clarifies a lot my question. The only small question I have related to the example that you just raised is about the risk level. I mean, when you said in your example, assuming a risk level of 80%, I mean, what are the drivers behind this assumption? I mean, why
Very good
80
question.
and not 70 or not 95? What is the
Very good
driver of the
question.
risk?
Yeah, very good question. So that's actually the core algorithm, the core calculation logic in FlexUp is to associate a risk factor for given payment terms, right? So the payment terms are a set of parameters that determine how the company is supposed to pay you. So you say, I'm going to invest 1,000 euros. If the company has the obligation to pay you back 1,000 euros tomorrow, you're taking no risk and the risk factor is 0. If it pays you in credits, and those credits will be only paid, sometime in the future when the company makes profit, then I assign this. Basically, I assign this to this 80% risk factor, which is a way of saying that the net present value of the 1,000 euros that the company is supposed to pay you sometime in the future. You don't know when it's going to pay you. You don't know if it's going to pay you all or only part in one instance or in several payments. You don't know. So the net present value of this promise is only worth 200 euros today. I discount it by 80%. Now you can ask me, where does this come from? And I say, well, at the end of the day, it doesn't matter if the risk factor is a true reflection of the risk, because there's no way. I mean, by definition, risk, it's very hard to estimate it. So what's important is not so much that the calculation of the percentage is precisely correct. What's important is that it's very simple to calculate and it's the same system for everybody. And it's more or less, thank you, Thibault. Thank you for joining. So it kind of feels reasonable, and it's the same for everybody, so that you can of course jointly agree to tweak the parameters and say, well, for our business, we don't want credits to have an 80% risk factor. We want it to have a 70% risk factor. And then you just go in the charter, and when you sign your charter, you just change that. You're free to change those parameters. Of course, the app is not yet able to cater for all of these tweaks. In the future, I hope we will, because maybe somebody's going to do a PhD on risk using the FlexUp system and say, sorry, guys, based on statistics, it shouldn't be 80%, it should be 75%. That's possible. But at this stage, it doesn't matter. I mean, what matters is that we all play by the same rules, and that on a given date, the payment structures are used to calculate risk in a systematic way that applies for everybody. But the whole algorithm and the way that the risk is calculated is a little bit complicated. That's why we have an app to calculate it. But the basic principles are very simple, and you can just see it in the charter. So it's like basically different priority levels. You have like firm, flex, credits. Do I pay you in a year's time, in a week, in a month's time? Do I pay interest rates or not? So there's like 10 different parameters that are used by the algorithm to calculate the risk.
Okay, so Fabrizio, you already used the interest rate because that was also a question of mine, because some of stuff converts into tokens and some converts into credit. And the credit is basically a promise of payment that is not necessarily going to be based on shares. But because it's in the future, I suppose there should be an interest attached to that. So that is also calculated in your app.
Yes, I will. I think the best way to answer your question is to give an example. So let me sign into the FlexUp app. I'm going to share my screen. I hope you can see it. Right. So the way this
Yes.
works is you go on the payment terms, and I need to go into. Let's go into this one. So I'm in the FlexUp account. So this is the FlexUp project. Okay. And the first thing I need to do is I need to check, did I sign a charter? Yes. This is a project that is being managed according to the principle of the FlexUp charter, because the holder has signed the charter and the initial value of the token was 10 and the annual indexation rate was 25%. And because now we're in 2026 and a few months have passed, the value of the token is now 10.4. And they decided not to issue stocks for this specific project. So these are options that you can select. And you can download the charter, and the charter will give all the information regarding the specific conditions that have been agreed for that project. Yeah. So the app automatically generates a contract. You see here, the legal entity is FlexUp, and then this. So of course, this is random data that we just put in the sandbox. Now, what I wanted to show you is that when you create a payment terms, let's say that I want to create a custom payment term, which is going to be credits. Sorry, we're going to use flexible payment terms. Credit 5%, right? So I want to create a new type of payment term that I'm going to use for specific contract, where I'm going to pay someone using the credit priority level from the date that the money arrives in my account. So you're investing $1,000 in credit using these payment terms. And from the date that the money arrives in my account, you're going to pay me 5% from the delivery date. So when the money reaches my account, and you're going to pay me those interest every quarter on a flex basis, right? And the company has the option to buy back the tokens. So as you can see, and it's very transparent, right? I mean, there's a lot of rules behind, but each rules are very simple. So I say that the credit has an 80% risk factor. And because you want a 5% interest rate, this has a 66.7% risk factor. And then because you want to get this payment on a flex basis every quarter, you actually, you're reducing your risk factor. And then here you're boosting your risk factor because you give the project the option to buy you back the shares. So for those specific payment terms, the app will calculate that the risk factor is 38.4%. So if you make an investment of 100 euros, you get 38 euros of tokens. And if the token index is 10 euros per token, you get 3.84 tokens. So far, everybody's been using credits without any interest. Why? Because you want to get maximum amount of tokens. And you're saying my risk is compensated not by the interest rate. My risk is compensated by the tokens I get. Okay, so now instead of getting 3.5 tokens, I'm getting 10 tokens. So if I believe this business is going to boom, I don't care about those 5% interest rate. What I want is as many tokens as possible. So the FlexUp system and the app is designed to allow you to charge interest rate. And if people charge interest rate, that means they're going to get paid first before the others. So they take less risk, but they will get a smaller share of the total profits. Now you could argue, well, 66%, that's wrong. It should be 50. Well, again, it doesn't matter exactly, how this is calculated. What matters is that you have the choice to take more or less risk. The app tells you how much risk, what is the risk factor and how many tokens you get. And based on that, you can freely negotiate to have interest rate, more or less, have no interest rate. It gives you this freedom, this flexibility, and the transparency and the simplicity of the app doing all the calculation for you.
Okay, thank you.
Is that clear,
Yes.
Alessandro?
Yes, it's clear. Alessandro, do you have?
Yes. It's very clear. If I may ask, I have another really small question. The risk factor that you were speaking before, about 80%, is something that is fixed for all the life of the company, or is something that you can adjust year by year? I mean, the risk of our startup is of course higher now. It might be less from 1 year from now. It might be even lesser in 2 years. So is a factor that is adjustable year by year, or your recommendation is to keep it flat for all the life of the company?
That's an excellent question. So there's 3 mechanisms to address the fact that over time, as a company grows and generates stable revenues, the risk actually goes down, right? There's 3 different ways to address this. The first one is to say that the annual token indexation rate decreases. So you can, as the assembly of all the associate, you vote and say, okay, from now on, instead of the token price increasing by 25% per year, it's going to increase by 10% per year. That's one mechanism. Another mechanism is to change. Oh, sorry. The second mechanism is regarding specifically the risk factor for the flex. The flex is an intermediate risk. It's an intermediate priority level. Again, let me share my screen. And I mean, we're going into the details, and I think that's why this is a workshop. It's not just a commercial presentation. It's a real workshop, so I can go into the details. But you see that here I have an intermediate level called flex. Flex, what does that mean? It's a priority level where at the end of every month, if the company has enough cash, it will pay the flex. If it doesn't have enough cash, then it can either convert it to credits. That's the residue. So if I cannot pay the flex that I was supposed to pay on the due date, then the residue converts into credits. That's one option. Or you can say the residue will be paid in flex the next year. Right? So you see that the payment terms is a lot of different parameters. It gives you a lot of flexibility. Now, let's assume you have agreed to this system, for example, right? And then let's assume there's no interest. So if you have no interest, none of these parameters matter, right? So let's just keep it simple. So this is kind of the basic flex. It's 40% paid at the end of within 15 days at the end of the period, right? The risk factor is 20%. Now, if the company just started and it never paid any flex because it never had enough money to pay the flex, then of course the risk factor is not 20%, it's much more, right? So what we do is we look at the risk factor of the flex, which is 20%, and we look at the average payout ratio of the flex commitments over the last months, and we factor that in. And if we've never paid any flex ever, then the risk factor of flex is the same as the risk factor of credit, because you are pretty much guaranteed that your flex payment will not be paid and will therefore be automatically converted into credits. So that's why the actual risk factor for that specific month will be calculated based on the default risk factor and the average payout ratio. So this is a little bit more complicated, but it answers specifically that. Was I sharing? I think I stopped sharing, right? Stop sharing.
No, you're
So
still sharing. Yeah.
Okay. So that second mechanism is a bit more technical, and I can see that you're already thinking far ahead, and I love that. This second mechanism is designed to take into account the fact that if the company is never paid the flex, then the risk factor for the flex is the same as the risk factor for the credit, basically, right? That's the second mechanism. Both of these mechanisms are fully implemented operation. They work in the app, and they're very well detailed in the charter. Now, there's a third mechanism which I haven't implemented yet, but it's possible. At least you can do it in the charter, but it's not yet implemented in the app. And that's why my dev team is certainly going to be very interested to hear this feature request. Is at some stage we will give you the option to change these parameters in your account, so that when we calculate the risk factor for the credit, instead of saying it's 80%, it's now 60% or 50% or 20%. And then we would be changing the core parameters. So the short answer is yes, the FlexUp economic model gives you that option, but the app doesn't have that feature yet. Hopefully, I mean, I hope your business will be so successful so soon that you will need to reduce the risk factor before we have the time to add the feature to the app. Otherwise, maybe we're going to add the feature in the app before you need to reduce the risk factors.
Okay. Thank you, Fabrizio. Thank you for the.
I hope your business is going to expand so fast that we won't have the time to to add that feature.
So. We hope to. Thank you, Fabrizio. Thank you.
Yes. Okay.
Grazie, Fabrizio. Grazie. Very useful.
Fabrizio, I have just one question.
Yes.
For the token rate, when you talked about the token rate, I think that when the company gets more stable and less risky, I think you should increase and not decrease the token rate. So more the token will be more expensive. So it guarantees that it will be expensive too to own it by other stakeholders or participants in the same project.
Yeah, I see what you mean, Anwar. So that's something I also need to explain. There's two different things that relate to the token. One is the token price, which I call the token index. And then you have the annual token indexation rate. These are two separate parameters. So the token index reflects more or less the current value of the company. Let's say you started with a token index of 10 euros and you go up every year by 25%. And then 3 years down the road, the token index is, I don't know, 3-4 years down the road, the token index is 20 euros per token. By that time, your company is successful, generating, a lot of revenues, and you have a very solid business plan. You go and see some investors, some venture capitalists or whatever, and you say, based on the future projections, we believe the company is now worth 10 million euros. And that means that the token index is actually 500 euros. It's not 20, it's 500 euros. And you sit down with all your associates and you decide to, of course, you wait for the VC to agree to that valuation. But if the VC agreed to the valuation, you sit down with your associate, you vote to increase the price, the value of the token from 20 to 500. To increase the value of the token, you just need a simple majority decision. If you want to decrease it, you need more than a simple majority. You need like 75% because that means the company is in deep trouble and you need to reduce the value of the token. But if you want to increase the value of the token, you just need the majority of the token holders to approve. So that exactly fits the situation that you described, Anwar. Now the company has a lot of value. We increase the value of the token. But maybe at the same time, you say, well, the value has increased, but the risk has decreased. And the annual rate at which the token keeps increasing, that is based on the risk, not on the value. So you can say, we're going to go from 20 euros per token to 500. And at the same time, we're going to reduce the annual indexation rate of the token from 25% per year to 15% per year. Does that make sense, Anwar?
Yeah, I fully understood. Thank you.
Great. Thank you so much. Okay, we have Celine who joined the call. Celine, do you want to say a few words about your business, or do you still have questions, Maria? And
I think Alessandro dropped out, but I don't have any more questions. Thank you so much, Fabrizio. It was super helpful. We love it.
Great. Okay. Celine.
Maybe other people from the team can see this. Thanks.
Sure. So Alessandro, please go ahead and ask the next question.
Yes. This is very practical, so tell me if it is too stupid. I mean, in the initial stage, as you mentioned, this tool is also done in order to avoid the young startup to not creating the legal entity since the day zero, okay? And it is protected by an incubator company, no? Or you call incubator company. So my practical question is, if we have few customers to whom we have to raise invoice, is this incubator company the legal entity that are the one who deliver the customer, or how is it set up?
That's a very good question. And that's exactly why we have in the FlexUp Charter this concept of the holder. So the holder is, from a legal point of view, the owner of the project and the legal entity that issues the invoice and receives the invoice. So the invoice of other parties are invoiced to the holder, and the holder is the one who is sending the invoices out. Now, that is in the case where you select an incubator as the holder and you decide that the incubator would be the only one receiving and issuing invoices. However, we still have the option, if you create your account as a sub-account, let's say, Alessandro, you're going to say, hello, my fellow co-founders. I already have an established business, which I use for consulting or whatever. I can legally issue invoice, receive payments. So I can play the role of the holder. Initially, I create a sub-account, and now all the business will be done in that sub-account. All the equity, all the tokens will be in that sub-account. But from a legal point of view, I'm owning the business. But from a contractual point of view, we have a contractual agreement to share the value between all of us according to the rules of the FlexUp Charter. In that case, you could be the one issuing and receiving the invoices, and you still have the option for Maria or other founders to also issue and receive invoices on their own account, provided that they record it in the FlexUp app under that specific sub-account. Now, this is a bit crazy because then you may lose your head. So I don't recommend it. I think it's much cleaner to have all the transactions done on behalf of a single legal entity, which is a holder. But the FlexUp framework, the FlexUp app allows this flexibility. This is especially useful, I would say, in countries where a lot of people operate in the informal economy. Basically, nobody has a business. People are working in small villages and everything is done, very informally. So that's why I had to design the FlexUp system to allow for this very large latitude. But of course, the simplest solution, if you want to start, focusing on your business without having to be concerned about creating a legal entity, the best is you select an incubator and you create your entity as a sub-account of that incubator, or one of you guys that has an existing legal structure can be selected to be the holder.
Okay. But when you say you select an incubator, this means that you already have inside your service, you already have a list of possible incubator from which we can pick up the one that best fits our need?
To be honest, not yet, but that is certainly our plan, yes. And we're working with Paola to set that up.
Okay. Thank you, Fabrizio. Sorry if I raised too many questions, but
no, I mean, I love this. I'm sure a lot of people will be very interested by all of these questions and clarifications. Okay, so I think we covered a lot of ground. Thank you so much, everybody, for participating in this call. I think it was. I found it very, very exciting for me to hear about Lara and to hear about your specific situation. And I hope that we're going to have a lot more of these workshops with a lot of founders that have exciting stories to tell. Thank you so much, and have a good evening, and I hope to see you around soon.
Thank you.
Bye-bye.
Bye.
Bye. Thank
Okay,
you.
bye,
Have a nice
everyone.
evening.